In 2005, a hedge fund manager named Michael Burry began reading mortgage bond prospectuses, not summaries, not analyst reports, the actual underlying loan documents, hundreds of pages of them, for thousands of individual loans bundled into mortgage-backed securities. What he found was that a significant portion of the loans being bundled into securities rated as low risk were adjustable-rate mortgages issued with minimal documentation to borrowers whose ability to make payments depended on home prices continuing to rise indefinitely. The securities containing these loans were rated AAA, the same rating given to U.S. Treasury bonds by the same rating agencies whose revenue depended on the banks issuing the securities continuing to pay for ratings. Burry concluded that a significant portion of the U.S. mortgage market was going to default, that the securities built on those mortgages were mispriced, and that there was no financial instrument that allowed him to bet directly against them. So he asked the major investment banks to create one. He convinced Goldman Sachs, Deutsche Bank, and others to sell him credit default swaps on mortgage bonds, essentially insurance contracts that would pay out if the bonds defaulted. The banks sold him these contracts because they didn't believe the bonds would default either. Burry was, in effect, asking sophisticated financial institutions to take the other side of a bet they considered close to free money. By 2007, Burry's analysis proved correct. The contracts paid out. His fund returned approximately 489% to investors over the life of the trade. What happened in between Burry identifying the problem in 2005 and the market confirming he was right in 2007, the part of the story that gets compressed into a montage in the film adaptation, and that contains the actual lesson. Burry's investors were not pleased with his trade. The credit default swap contracts required ongoing premium payments, money flowing out of the fund every month with no return, for a period of time that nobody could predict in advance. From the perspective of an investor looking at monthly statements in 2006 and early 2007, the fund was losing money on a position its manager had taken based on an analysis that, as far as the investors could tell, was contradicted by every other signal in the market. Housing prices were still rising. Other hedge funds were not making this trade. The rating agencies had not downgraded the securities. The investment banks that had sold Burry the contracts were not behaving like institutions that believed a crisis was imminent. Burry's investors began demanding explanations. Several demanded that he exit the position. Some attempted legal action to force a redemption of their investments, which would have required Burry to unwind the trade before it paid off. Burry, in letters to investors that have since been published, described the period as one of the most difficult of his professional life, not because his analysis was being questioned on its merits, but because almost nobody was engaging with the merits at all. The questioning was about why his results looked different from everyone else's results, and the assumption embedded in that question was that different meant wrong. Have you ever been correct about something and found that the correctness itself was treated as suspicious because it diverged from what everyone around you was reporting? Leave a comment. The specific mechanism here is worth naming precisely because it is not unique to Burry's case, and it explains why being right early is so often functionally indistinguishable from being wrong. In any system where performance is evaluated by comparison to peers, and most financial performance evaluation works this way, a position that is correct but not yet realized looks, in every interim measurement, identical to a position that is simply wrong. The fund manager whose portfolio matches the index is performing as expected. The fund manager whose portfolio diverges from the index in either direction is the one whose judgment gets questioned, because divergence itself, prior to the resolution that proves it right or wrong, is the signal that gets evaluated. This means that correct contrarian positions and incorrect contrarian positions are, for the entire duration before the outcome is determined, observationally identical to the people evaluating them. The information that would distinguish them whether the underlying analysis is sound acquires the same depth of engagement that produced the original analysis. Most evaluators, including sophisticated investors, do not have the time, expertise, or incentive to derive Burry's conclusion from the same mortgage documents he read. They have only the divergence from the consensus, and the divergence is the only data point most of them act on. Burry was, during this period, simultaneously correct and, by every observable metric available to his investors, indistinguishable from someone who had made an expensive mistake. The information that would have resolved the ambiguity, the actual loan-level data Burry had analyzed, was available. Almost nobody looked at it, because looking at it required the kind of effort Burry had already put in, and the consensus view made that effort feel unnecessary. If the specific mechanism here not Burry was right, but why being right looked exactly like being wrong for 2 years is the level of analysis you come here for. The like is the direct signal. The people who lost the most when the mortgage crisis arrived in 2008 were not, for the most part, people who had access to the kind of analysis Burry had conducted. They were homeowners whose adjustable rate mortgages reset to payments they could not afford, retirees whose pension funds held mortgage-backed securities that had been rated as safe, and the employees of Lehman Brothers and Bear Stearns and dozens of other institutions whose business models were built on the assumption that the securities Burry had identified as mispriced were, in fact, priced correctly. Burry's fund made money. His investors, the ones who stayed, made significant returns. The information that would have protected everyone else was, in a sense, the same information. The underlying loan documents were public. The mathematics of what happens when adjustable rate mortgages reset on borrowers who can't afford the new payments was not exotic. The rating agency's conflict of interest was structural and visible to anyone who looked at how they were compensated. What Burry did that almost nobody else did was spend the time to actually read the documents rather than rely on the rating, the consensus, or the behavior of other sophisticated actors as a proxy for the underlying reality. This is not a story about superior intelligence. Burry has been candid that the analysis itself was not especially complex once you did it. The barrier wasn't the complexity of the analysis. It was the willingness to do analysis that the entire system around you was telling you was unnecessary. The 2008 financial crisis cost the U.S. economy trillions of dollars and an estimated 8.7 million jobs. The information that would have allowed institutions to prepare for it was sitting in publicly available mortgage documents for at least 2 years before the crisis arrived, read by a small number of people whose conclusions were, during that entire period, treated as the noise rather than the signal. The lesson from Burry's case is not trust contrarians. Contrarian positions are usually wrong, which is part of why consensus exists and why divergence from it is treated with suspicion in the first place. Most people who are confident the market is wrong are, in fact, simply wrong. The lesson is more specific and more uncomfortable. The mechanism that protects organizations and markets from acting on every confident contrarian also protects them from acting on the correct ones, and there is no observable signal during the period when it would matter most that distinguishes the two. The correct contrarian and the incorrect contrarian look identical for as long as the outcome remains undetermined, which is precisely the period when the information would be most valuable. The practical response is not to treat every divergent view as potentially correct that produces paralysis and rewards confident cranks as much as correct analysts. The practical response is to separate the evaluation of a position from the evaluation of its current performance. Burry's position should have been evaluated on the quality of the analysis underlying it, the loan documents, the default mathematics. The rating agency conflicts independent of whether the position was currently making or losing money. Almost nobody did this, including people whose job was specifically to do this. The question worth asking of any position, your own or someone else's, that is currently diverging from consensus: if I set aside the current performance entirely and looked only at the underlying analysis, would I find something that requires a response? That question is answerable in real time, before the outcome resolves it for you. Almost nobody asks it, because the current performance is right there, and the underlying analysis requires the kind of work that current performance seems to make unnecessary. The next episode looks at what happens after outcome resolves, at the post-mortem process itself, and at the specific things that even careful post-mortems consistently fail to capture. This content was developed with the support of artificial intelligence tools and underwent human review, editorial curation, and approval before publication. The analysis presented here is strictly educational and philosophical in nature, grounded in behavioral psychology and classical Stoicism.